Hi, everybody. I'm Robin Lumsdaine. I'm a professor of international finance at the Kogod School of Business at American University. I'm a senior fellow at the Center for Financial Stability. I'm also on the advisory scientific committee of the European Systemic Risk Board. And previously, I was an associate director at the Board of Governors at the Fed. It is my absolute pleasure to be here today to moderate this next panel. We've got a great slate for you. I should mention, by the way, Andy in the first panel mentioned that if you stand at the podium, you become a preacher. Let me just say that this is default. There's not a chair for me, so here I am. I have no intention to preach, lest you all be worried about that. We've got enough of a distinguished panel that I'm sure you'd rather hear their views. As I said, it's a pleasure to be here, and it's just such an honor. I've known about, I guess I'll start with the Center for Financial Stability. I've been associated with the Center for Financial Stability almost from its inception. I have been very proud to be associated with an organization that values inquiry, constructive criticism, nonpartisan views, and really does exactly what Larry said, engages the community of people to talk about and wrestle with real-world issues. We saw that with the first panel today. I think there's no time more great than now to really emphasize the importance of having a forum for critical and constructive debate. I was so delighted to hear about the partnership with the Shadow Open Market Committee. Known about the Shadow Open Market Committee for a long time. I have to admit that one of the things I didn't know was that its meetings were public and open, and I'm delighted that they are, and delighted to be a part of this. We've got a terrific panel today. Just want to emphasize the title of the panel is How Should the Fed Systematically Respond to Unfolding Developments in Trade Policy? One of the things that people know from, if you've seen me moderate before, is that I encourage questions and answers. I don't think there's going to be any problem today, but just start preparing early for questions related to this topic. Now, I should mention that when I was asked to moderate this topic, basically said, okay, I'm a professor of international finance. Those of you who have taken international or specialized in international in school know that there's international finance and international trade. I'm not the trade person, I'm the finance person. Okay, but I'll tell you that when I read the papers today, I also discovered that there was very little about trade. So we all fit together very well, and that's something that's going to be great. But one of the things that I think is important about the papers, and the authors will present some remarks, is that, again, some of the implications of what they're talking about apply today in a situation where shocks to the system are arising through the trade channel. And so it's important to think about how we can extrapolate the lessons that we've learned in the past, some of the things we know, to the current situation. I think the other thing I want to emphasize is, as Mike mentioned earlier, that in some ways, discussion and criticism of the Fed is not new, and so I think it's really important to bring that lens into thinking about how new shocks are arising as we go forward. So without further ado, I want to introduce our panelist. Peter Ireland is the Murray and Monty Professor of Economics at Boston College. He's on the Shadow Open Market Committee. He's been there since, I don't know if I should say because Mickey refused to say, but he's been there for more than a decade. He's an advisor and visiting scholar at the Fed. He's been an advisor and visiting scholar at many Federal Reserve banks. I was amazed how many. And he's an expert on money growth and the role of money. Mickey Levy, who you already know, he's a visiting fellow at Hoover, head of the Shadow Open Market Committee. He's been a longstanding member, and he was previously chief economist at Bank of America, as well as many other things. And his research is on monetary and fiscal policies and their influence on economic and financial market behavior. Mike Bordo, who is someone that I've known for probably longer than people have been on the Shadow Open Market Committee, is a distinguished professor of economics at Rutgers, also a visiting and distinguished fellow at the Hoover Institution, member of the Shadow Open Market Committee. So without further ado, I'm going to have Peter start his presentation.
Thanks so much, Robin, for that very nice introduction, and thank you very much for being here with us today. So it At past Shadow Open Market Committee meetings, I've outlined some of the advantages to nominal GDP targeting as a framework for monetary policy analysis and evaluation. Today, I'm going to focus on just one of those points, but it's the point that seems most relevant for the circumstances we find ourselves in today. And that is what I would call the robustness of nominal GDP targeting in the face of large shocks to the supply side of the economy, including but not limited to large changes in tariffs. So first, regarding aggregate supply, federal open market committee members, they like to draw a distinction between aggregate supply shocks, which they say generate purely transitory movements in inflation, and then shifts in aggregate demand, including shifts in monetary policy, which again, in their terminology, are capable of generating more persistent movements in inflation. Now, that distinction between transitory and persistent inflation, it's not wrong, and it can be helpful at times. I guess I would say it's insufficiently precise, and therefore can generate confusion at other times. A better way of making the same distinction would be to say, aggregate supply shocks typically generate one-time changes in the level of nominal prices, whereas shifts in monetary policy are capable of generating movements in the growth rate of prices, that is, in the inflation rate itself. So point number one is just that. In thinking about tariffs and in thinking about the appropriate monetary response, if any, to tariffs, it would be better to replace transitory versus persistent with levels versus growth rates. Now, second, regarding tariffs in particular, I think, given recent discourse, it's fair to say there are some people who really, really love tariffs. There are other people who really, really hate them. Okay, but the good news, if you want to call it that, is if you're a central banker, it really doesn't matter what you think about tariffs, like them or don't like them, good or bad. And that's because there's really nothing that monetary policy can do to offset or change the effects of tariffs. Monetary policy is an inappropriate policy tool for influencing the intersectoral distribution of real resources or allocation of real resources. And that's exactly what tariffs are aimed at achieving. So to use the language of the theory of central banking, what Federal Open Market Committee members need to do right now is to look through the one-time price level effects of tariffs and keep their focus where it belongs, on intermediate term trends in the growth rate of prices, that is, again, on the inflation rate itself. Now, this idea of looking through the one-time price level effects of an aggregate supply shock, it's not a new idea, and it's not an obscure idea either. I hadn't seen Mike and Mickey's paper for this session until a few days ago, but when I saw it, when Mickey sent it to me, I saw they too refer to what I'll call this looking through approach. I wouldn't say it's like common knowledge, but I guess I thought this was part of like central banking 101. As a matter of fact, there's a very nice recent paper written by Ed Nelson, an economist at the Federal Reserve Board, that traces out the theory and the history behind this looking through approach. Ed's paper is written in the clearest possible terms. Okay, it's accessible to anyone involved in the monetary policy making process, and it provides numerous examples of instances in the past where the looking through approach has been implemented successfully by central banks around the world, confronted, as the Fed is today, with large adverse shocks to aggregate supply, most of the time having to do with changes in national sales taxes, like in Canada and Japan, but the general principle is more or less the same. Now, there's more than a little bit of irony here, it seems to me, because in recent months, both President Trump and Treasury Secretary Bessent have questioned rhetorically the need for so many economists at the Federal Reserve. They're within their rights to ask that question, but somebody ought to answer the question by referring to papers like Ed's that speak in real time, again, in the clearest of possible terms, to the issues and problems that FOMC members, again, are facing in real time. The irony comes about because, as far as I can tell, nobody on the FOMC has read or even heard about Ed Nelson's paper, because if they had, they would understand that the so-called problem of tariffs for monetary policymakers is not really a problem at all. Or if you want to call it a problem, it's a problem with a well-known solution, time-tested, that they can take and use right off the shelf. Now, what is true, in fairness, is that implementing this looking-through approach, it raises a communications issue for FOMC members, since, to go back to use their own language, they need to explain to the public just why it is they're allowing for the purely transitory increase in inflation that's reflective of the one-time increase in the price level generated by tariffs. But here's where nominal GDP targeting can come back into play, because even as adverse supply shocks will raise the price level, they'll also lower the level of real GDP. That's part of the reason why some people hate them. But the point is that aggregate supply shocks have muted effects overall on nominal GDP growth. So by focusing their attention on nominal GDP growth, and by emphasizing that, especially in the presence of aggregate supply shocks, underlying trends in nominal GDP growth provide the most accurate reading on the stance of monetary policy, accommodative, restrictive, or neutral, FOMC members can help themselves implement this looking-through approach and also better explain to the public what they're doing and why. Okay, now, one last point before I conclude. Pardon? Oh, one last point before I conclude. Okay, I wasn't sure whether I was going to say this today, but I will. It turns out I'm actually pretty bullish these days. If you don't agree with the forecast, instead just take this as a description of one branch on an event tree where things may actually work out pretty well. Okay, but my gut feeling is that most forecasts of U.S. economic performance for 2026, this applies to forecasts from the Fed, is reflected in the SEPs, and from the private sector too, they're far too pessimistic. I think economic growth is going to be significantly more robust next year than most analysts expect, and I think outcomes for inflation are going to be better too. I think the reason for this excessive pessimism is just that economists are so obsessed with the effects of tariffs that they're totally ignoring other elements of the Trump administration's economic agenda, many of which are sending powerful, offsetting, favorable supply-side impulses through the economy by encouraging these things: entrepreneurship, innovation, energy independence, investment, growth in jobs. All of these things are going to lead to more robust growth in income and jobs right around the corner. So to conclude, if I were advising the FOMC, I'd point them to Ed Nelson's paper, and I would say, implement this looking-through approach to the one-time price level effects of tariffs by keeping the focus on underlying trends in nominal GDP growth. And then I would advise, even more importantly, just stop talking so much about tariffs. There's nothing monetary policy can do about tariffs. By talking about them all the time, it just comes off in the ears of many in the American public, and to me included, is whining. It's unnecessary, and it's got to stop. If I was advising the Trump administration, on the other hand, I would try my best to counsel patience. Okay? I don't particularly care for the way that many FOMC members are talking so much about tariffs. It does give me the impression that maybe they're biased against the Trump administration's initiatives. But if you take a look at underlying trends in nominal GDP growth, obviously we don't have the most recent data. But if I had to guess, I would say nominal GDP growth year over year right now, it's probably running at a rate somewhere between 4.5% and 5%. That is still too high to to be consistent with a surefire return of inflation to the 2% target. So let the Fed finish the job of bringing inflation back down to 2%. That's going to reinforce, not offset, the many other favorable trends prompted by Trump administration initiatives, which, as I said, I think will lead to faster rates of growth in income and jobs right around the corner. Thanks.
Thank you, Peter.
Okay, so our paper is about, it very much complements what Peter Ireland said. It's about monetary policy responses to shocks. And so most of the work that central banks do is, a key part of their work, it's not just most of, is to stabilize the business cycle. It's called countercyclical monetary policy. And in normal times, the Fed is supposed to stabilize the business cycle, but also maintain price stability. Okay, but what we look at is, in a sense, periods that are not necessarily garden variety recessions or business as usual, but these are situations where the Fed has to deal with shocks. And shocks means it's something that comes from outside. It's totally unanticipated. Okay, it also could be induced, the shocks could be induced by problems with previous Fed policy. But so what our focus is, what do you do about shocks? And what we do is we look at three big shocks in the last 20 years or so, the last 60 years or so, the Great Inflation, the Great Financial Crisis, and the COVID shock. And we also look at smaller disturbances, steel strikes, credit crunches. There are a whole lot of stories that go back through the 20th century, and so we talk about them. And what we find is that the Fed has tended to respond to shocks in ways that often lengthen and increase the damage that the initial shock imposed on the economy and on inflation. So in a sense, even though Peter's laid out what they're supposed to do, they often don't do it. And so what the Fed has tended to do in history is to respond to each shock in an unsystematic way. And we think that some of the judgments the Fed's had on the impacts of external disturbances to the supply side and to demand can often be not fully reliable. The Fed typically does not carefully distinguish between the appropriate responses to shocks in supply and demand. And so what we think is that, in a sense, monetary policy would benefit from a more careful assessment of history, which is a point I've always been pushing. And so what theory suggests, and this is just repeating what Peter said, is the Fed should lean against shocks to demand and look through shocks to supply. So the Fed should ease in response to a negative demand shock, demand impulse, and tighten policy in response to positive demand impulse. And the goal is to smooth aggregate demand. And the Fed should not respond to supply shocks, because monetary policy is an aggregate demand tool that's incapable of offsetting the economic impacts and distortions of supply disturbances. And in fact, most shocks, many, not all, but are temporary, and the impacts are quick, and that's why they use this term transitory, whereas monetary policy works with lags. Okay, and if policy reacts slowly, that can get embedded into inflationary expectations. So what we're going to do is, I'm going to let Mickey, even though I'm the historian, I'm going to let Mickey tell some of the stories. Okay, so I'll turn this over.
Pleasure to be here. So once again, this paper is about monetary policy responses to shocks. So it's not smoothing aggregate demand. It's responding to shocks. So Mike laid out the framework of our paper, and so I'm going to talk about three quote-unquote shocks: the Great Inflation, of 1965 to 82, and then the GFC, and then COVID. And we may not have slides, so you just have to listen to me. So the Great Inflation began in 1965, and it was much, much more than just two oil price shocks of 1973 and 79. It began in the mid-1960s and involved decidedly misguided economic policies. There was a surge in government, not just government spending, but government purchases related to the Vietnam War and the Great Society program. And this generated a big increase in demand beginning in 1965. President LBJ put extreme pressure on Fed Chair William McChesney Martin not to raise rates. The Fed gives in to the pressure. Inflation starts rising in 1965 from 1.5%. The Fed raises rates less than 1 for 1, and with the aggressive fiscal stimulus and the Fed's monetary accommodation, inflation goes from 1.5%, where it had averaged for the prior dozen years. It goes from 1.5% to 6% by 1969. Okay, so it ends this dozen years of what was pretty close to price stability. Then along comes in February 1970, Arthur Burns becomes chair of the Fed. Going back a step, the Fed started raising rates immediately after LBJ announces he's not rerunning for president. So it's too late, but it raises rates and catches up to inflation. You see, so Burns comes into office in Feb 1970, and you're in the middle of a sharp slowdown in aggregate demand based on what the Fed had done, raised rates, and Burns is hit with a U.S. postal strike. The economy dips and begins, and it harms the economy. Then in the fourth quarter of 1970, you have the GM goes on strike, the biggest strike in history, and during a year, from Burns' first year in office, he lowered the funds rate from 9% to 3.7%, below the rate of inflation. And Burns always believed, you can go back and read Burns, he always believed that inflation was due to non-monetary factors, and he doesn't trust monetary policy. So you have this rising inflation associated, and the dollar was falling, and this led to a major repatriation of gold. So along comes August of 1971, the Nixon shock, where Nixon abandons the gold standard, officially eliminates the anchor of stability, and imposes wage and price controls because he didn't believe monetary policy worked. And then within months, the 1972 election, Burns is purposely keeping interest rates low to try to reelect President Nixon, and you have this dramatic acceleration in aggregate demand, and with wage and price controls, all of the acceleration in nominal GDP becomes real because you have wage and price controls on, and then immediately after the election, but too late, the Fed starts hiking rates, and then only then do you have the first oil price shock in November 1973. But what history, if you only think about the 1970s as two oil price shocks, inflation had already risen to 8% before the first oil price shock. So you had this threefold increase in oil prices, and then we had this deep 6-quarter recession. Inflation following the recession finally came down to 5.5. But during this whole recessionary period from mid-60s through 1982, inflation ratcheted up with every single peak and trough higher than the previous one, inflationary expectations rising. And by 1978, this created a dollar crisis and Carter bonds and all that. And before the second oil price shock, inflation had already reached 9%. So there's just this series of policy errors. So that the Great Inflation was way more than just 2 oil price shocks. It was misguided monetary and fiscal policies. And finally, Volcker comes in, shifts toward aggressive monetary tightening in October '79, raises rates to 17%, and President Carter still saw increasing credit, and so all forms of credit were still accelerating. So Carter forces the Fed to impose credit controls despite Volcker's opposition, and this led to second quarter of 1980, where GDP fell nearly 10% on an annualized basis. The Fed it forced Volcker to interrupt his disinflationary policy. You had interest rates going from 9% to 17% and all the way back to 9%, and then the economy rebounded in 80. Second half of 1980, and the Fed then proceeds in raising rates almost immediately to 19%. And so, the Volcker was the hero in enforcing disinflationary monetary policy, but regaining inflation-fighting credibility was complicated by the credit controls, and the short-run costs were 2 back-to-back recessions. So it is a very interesting period when you think about it, because it was a confluence of a lot of bad policies. And it wasn't just oil price shocks, it was missteps by the Fed, it was missteps for fiscal policy. So then we enter the Great Moderation, where inflation stayed relatively low from the early 80s through the early 2000s. And then I'm going to fast forward to, there were some minor shocks along the way, but I'm going to fast forward to the Great Financial Crisis. The Great Financial Crisis was not an exogenous shock. It had been brewing for years as a culmination of debt-financed housing bubble facilitated by sustained periods of low rates, Fannie and Freddie that we're going to get to later this afternoon, lax credit conditions, a proliferation of MBS derivatives, and poor financial supervision. And what's interesting here is beginning in the late 1990s, the Fed had these fears that there was going to be a Japan-style deflation. And this led, and by the way, Charlie Plosser wrote a piece on Japan's deflation in 1998 and said that was a specific problem to the BOJ and had nothing to do with the Fed. But the Fed became very concerned. So the Fed took upon himself to keep rates low, and it wanted to avoid deflation at all costs. And so in the early 2000s, the Fed keeps inflation, it keeps the funds rate at 1%, inflation goes back to 2%, and you had this boom in a debt-financed housing bubble, and then along came this this proliferation of complex derivatives and the failure of supervision. I've got 3 minutes to go. And the Fed provides all these, so then things start unraveling and you head into the financial crisis. But so you've thrown me off. Yeah, so you have this great financial crisis. The Fed steps up to bat and it addresses the crisis, and the scope of the Fed's monetary policy is expanded with all the QEs and this and that, and then you have a slow recovery. And the one point I'd like to bring out is the Fed, after the recovery had started, you have QE3 put in place in the end of 2012. And in so doing, the Fed transforms what had been emergency unconventional monetary policy of LSAPs, large-scale asset purchase, and it transforms it into a conventional policy that the Fed has a large balance sheet to stimulate employment. Okay, so this transformation of an emergency policy into a more conventional policy, and that's where we are today. And I'm not going to have time to go through the COVID response, where of course the Fed was far excessive. But I would like to let me just summarize things. When we assess the Fed's responses to an array of shocks, we find a fairly predictable pattern in which the Fed tends to adjust monetary policy to offset the short-run impacts of the shock without regard to the type of shock or the long-run consequences of the monetary policies. And this parallels the Fed's pattern of prioritizing employment rather than their inflation objective, which we see up to today. And the Fed has not heeded the advice of passing on supply shocks and disturbance, and instead pursues this activist monetary policy and fine-tuning. And this is proved costly. And just let me conclude by saying the Fed would really benefit by heeding the lessons of history and acknowledging that monetary policy is an aggregate demand tool and not capable of correcting distortions generated by supply shocks. Thank you.
Thank you very much, Mickey, and with apologies for pulling the hook. There's a couple of things I know. The role of a moderator is twofold. One is to facilitate discussion, which based on the first panel is not going to be an issue. And the second is to keep the time, and failure for me was not an option. So there we have it. So basically with that, I'm also going to use my moderator's discretion to ask a couple of questions, one of each paper. And I encourage you to read the papers. They're really chock full of things. And as Mickey illustrated, I mean, there's a lot more in the paper than what he had time to go through. So the first question I have is for Peter, actually, and it builds on this notion of stop talking about tariffs. Okay, one of the things that we know is when the Fed hit the zero lower bound, they had kind of exhausted some of the policy tools or the conventional policy tools they had at their disposal, and I believe started adopting communication as an informal policy tool. So to what extent is the stop talking about tariffs really a point about go back to traditional policy tools and stop using communication as a policy tool, and to what extent is it specifically about the tariffs?
Thanks. That's a great question. I guess what I would just turn the question around and say this is actually a suggestion for communications policy. If I was Fed Reserve Chair and I had to give the press conference after every FOMC meeting, if somebody asked, well, what about tariffs? I would just say that's not our business. That's not our department. tariffs are designed to affect the intersectoral allocation of resources. That's not what monetary policy is all about. And so we need to look through the one-time price level effects. The technical details of doing that, levels versus growth rates, maybe that's best saved for research articles and not press conferences. But I think by repeating the basic message again and again, that's the way to use communications policy effectively to respond, or in this case, not respond in exactly the right way.
Great, thank you.
Can I say something?
Yes, absolutely.
Okay, so last year at the Hoover we had a symposium on the tariffs, and Mickey and I were there, and a lot of other. Okay, Mickey and I were there, and a lot of other people, and basically, and one of the key presentations at that event was by Steve Davis, and talking about the Trump tariffs. And in a sense, what he argued was that policy uncertainty, okay, the way the tariffs were introduced, okay, and the way they're still being dealt with has had a serious effect on the economy, on investment decisions, et cetera, which in a sense is an issue that is going to affect the real economy. Okay, it's not so much an inflation story, it's a real economy story, and that the Fed really needs to take this into account. So sure, you impose tariffs, and we look at the history of tariffs, it's right. It is, this is an allocation issue. Okay, it's a winners and losers issues, but when you affect expectations, okay, then it becomes a macro issue, and then I think the Fed needs to be involved.
Thank you. Okay, and so my second question is for Mike and Mickey. In your paper, and as I said, it delineates this really well in the paper. Mickey did a great job of highlighting as well. You basically highlight three what you call major shocks, so the great inflation, the great financial crisis, and COVID, and then have a nice list, and there's a great table in the paper, have a nice list of what you call others, other shocks and then there's also a very nice grading of the Federal Reserve's response to this. So my question for you is, are tariffs one of the majors, or are they an other?
They're another. I mean, Peter's basically right.
Go back to my microphone.
But Peter's basically right, but I'm just saying that right now, there's another issue in terms of the way the tariffs are being imposed. Okay, but then if I go back to history, and I look at Smoot-Hawley, okay, that was a huge effect, and it did have real effects on the economy. And in a sense, the Fed wasn't even in the game then. The Fed was totally shut down in terms of dealing with situation. But I would say that's also something that monetary policy should have been involved with.
And also, just to follow up on that, because I was anticipating you were going to say that. So I think the other thing, if I look at your grading of the Federal Reserve, you're quite constructively critical and a bit harsh on their responses to the more majors. And it seems like they did okay in some of their responses to the other. And so part of my question is it easier to achieve a top grade in response to smaller, what we might call temporary shocks, than permanent ones?
Well, Robin, you bring up a great point. So let me, from our paper, let me read to you a list of some of what we call minor shocks that have occurred since the mid-60s.
I said other, not minor.
Okay, so the credit crunch of 1966 that was generated by Regulation Q and interest rates going above it. President Carter's credit controls of 1980, I mentioned, the stock market crash of 87, the Gulf War of 91, the productivity surge in the late 90s, the Asian crisis in the late 90s, 9/11. Okay, so the Fed is the central bank, and they're always being thrown minor curveballs at them, along with the bigger shocks, some of which are endogenously determined. And the Fed needs to really think about what its proper role is and how to diagnose what the curveball is. Is it supply or demand? Let me go back to a huge, very constructive response the Fed gave once, and that was the productivity surge in 1996, 7, 8, where, the economy was really taking off. It was very strong in every angle, and the unemployment rate was coming down, and there was a call by several Fed members to Alan Greenspan, the unemployment rate's coming down, we should tighten monetary policy. And Greenspan properly diagnosed that no, we're having a positive productivity shift, and that's not going to generate higher inflation. And so this is an example of how the Fed needs to think about the economy and diagnose supply versus demand, which isn't always easy. And then as Mike started out the discussion, how the Fed should respond to shifts in supply versus shifts in demand. Robin, let me just bring it to where we are now, and Mike and I have had this discussion. Okay, we have this debate now about whether monetary policy is appropriately set to reduce inflation to 2%. How do we factor AI into it? Is it a positive productivity shock that may raise productivity and along with it R star? These are really interesting questions that Mike and I in our discussions have said the Fed needs to really think long and hard about the economy, what's driving it, and what's the appropriate monetary policy to achieve its objective.
Right, so just to continue on that theme, so the headlines last week were all these big companies laying people off because of AI, okay? So the question is, what's that? To me, it's a supply shock, okay? But if you're the Fed and you're focusing on your mandate, okay, and you're looking at the labor market, you're going to think, oh, look, there's more people unemployed, and you're going to be thinking in terms of ease. Whereas if we follow the approach that we're talking about, and Peter, was that you should ignore it. You should focus on inflation, which is still too high. Okay, so this is where this confusion comes in. The dual mandate makes it difficult because part of the supply effects are going to affect unemployment, but it's a different kind of unemployment.
Thank you. Great. I think that's a perfect time to open things up for questions. Let's see. I saw a hand here, then 3 here, and 1 there. If we can maybe do 3 of them and then start over here, please. And then, like we did in the last panel, we'll have a bit of a response, and then we'll make sure to get the other 2 questions as well. Sorry, Christian, I think over there first. Sorry, apologies.
Hi, Pablo Villanueva, BWGI in the private sector. You mentioned kind of the different shocks, tariffs, AI. There's another big shock that has happened, which is immigration. It was 3-4 million people net immigration 2 years ago. Now it's close to 0. It has a bit of a flavor of supply shock. There's less labor supply, but also a little bit of demand shock. Many people argue that housing inflation, which is the major disinflationary force now, has been because of the low immigration. How are you thinking about how the Fed should respond to this lower immigration?
Thank you. And might as well ask the question over here, too.
Hi, first of all, welcome back to New York.
If you can identify yourself, please, just for the recording and the people
Douglas
online.
Carr. Yes,
Thank you.
Thank you. There's been a very high correlation in recent years between the primary fiscal deficit and inflation. So, to what extent do you think it's our fiscal situation that's been driving the inflation? And do you think with very different lags, probably, very different channels, that monetary policy can effectively offset fiscal inflation?
Thank you. Why don't we, while we're moving the microphone over, why don't we answer those 2 questions first, and then we'll come over here. Thoughts? Panelists?
Peter.
Well, actually, I mean, yeah, the microphone's there, so go ahead and ask the question, sorry.
Productivity and efficiency sometimes don't work quite as well as you would like.
Indeed.
Philip Chow, private sector. Couple of questions. One, if I understand correctly, that what the panelists have been talking about is monetary policy is either not necessary or let's not jump to conclusion when it is a supply shock rather than a demand side, if I'm hearing it correctly. If we just go back not too long ago, when the end of COVID, which we really didn't hear Mickey talk about the COVID piece, I suggest that this transitory thing that has gave them a really bad feeling, and they've been suffering ever since. And the fact that it was a supply shock first because everything closed down, blah, blah, blah. And so everybody wants stuff and stuff is expensive. If they've done nothing, which is possible, then the inflation went up, and then it's followed by a demand shock because then everything's opened up. And so how would the panelists feel if you're on the Federal Reserve? What would you have done during a period of supply shock? Because this is indeed if we consider a tariff as a supply shock, then how would you, as a panel, suggest that your communication as well as your action would have been?
Great, thank you. Why don't we answer those three just so my panelists can remember the questions, and Andy, we'll go next to you and then over there. But why don't we answer the questions first?
Sure. With respect to the issue about immigration in the labor market, I talk more specifically about this in the paper. I think it's always risky business. I call it a sucker's game to make monetary policy with such heavy emphasis on high-frequency labor market statistics, because we saw this when there were the revisions to the employment numbers. All of a sudden, it seemed like monetary policy, that the Fed was way behind the curve in lowering interest rates, et cetera. I think particularly now, where we know those numbers are going to be distorted by issues related to immigration, it's a particularly dangerous game. The thing I like about nominal GDP targeting is that nominal GDP growth decomposes into an equally weighted sum of real growth and price inflation. So you're still taking into account concerns about real economic activity. I think in this circumstance, as in many others, it's better to look at real GDP and inflation together as nominal GDP than to focus so much on labor market issues. I'm going to leave the fiscal policy question to Mike and Mickey, because actually I had that same question. But very briefly, regarding supply shocks, I mean, look, it's always hard to get things perfect. Decisions are being made under conditions of risk and uncertainty. We all know that mistakes happen and none of us expect perfection. But in regards to the two episodes you talked about, okay, 2020 was beyond, no one had the ability to anticipate 2020, and no one had the ability to know what was going to happen in the spring of 2020. So I give everyone a break when it comes to 2020. What I would say, though, is that by the spring of 2021, it was pretty clear that the tail end of bad outcomes that we were all fearing a year previously, those events had been ruled out. The economy was expanding vigorously, albeit unevenly, because of sectoral issues associated with the shutdowns and reopenings. But it was pretty clear that the Fed was behind the curve. That was evident, I think, for example, in the explosion of M2 growth. They should have known, and they should have normalize monetary policy more quickly. Here, I see it as more clear-cut. Again, if I were the Federal Reserve Chair, look, you don't have to love tariffs. It's not the Fed's business to offset the effects of tariffs. It's not the Fed's business to comment on, essentially fiscal policies, trade and regulatory policies. Leave that to the administration and leave that to Congress.
I want to get on this fiscal policy thing. Yeah, so, if you take an old-fashioned monetarist approach, you'd say, no, fiscal deficits don't cause inflation. It depends on how they're financed. So if they're money financed, then they do. Okay, if you go through the modern approach of John Cochrane and the fiscal theory of the price level, so what really matters is if the deficits are going to be offset by future surpluses. And if the public does not believe that they are, okay, then you will get an increase in inflation. So I think the question is, are these deficits going to be offset by future taxes? This is a question.
Okay, let me try to address some of these questions. On immigration, I agree that the issue hasn't been settled yet. But if you think about potential growth, the Fed estimates potential growth as 1.8%. I think it's low, but of their 1.8%, about 1.2 is productivity, and about 0.5 or 0.6 is labor force growth. If it comes to pass that immigration is shut off for a number of years, and that cuts into labor force growth, then that's going to lower potential growth, which presumably is going to lower the natural rate of interest, and the Fed would have to respond, but it's too early. Okay, on fiscal policy, how do I say this in rigorous terms? The Fed really blew it. Okay, so you had, there were three pieces of legislation: the CARES Act, the Budget Reconciliation Act in December 2020, and then President Biden's first piece of legislation was called the American Rescue Plan. Those three combined increased deficit spending by 25% of GDP. The checks that were distributed in April of 2021, 2 months after those checks were distributed, and after 25% increase in deficit spending as a percent of GDP, the Fed's quarterly summary of economic statistics did not change their forecast of real GDP growth or the unemployment rate or nominal. It didn't change. It assumed that the fiscal stimulus didn't work. And I would note that if you just look at the simple data in 2020, the second half of the year, you were accelerating sharply. 2021 and 2022, you had the fastest growth of nominal GDP in U.S. history. And that's aggregate demand. And amid that unprecedented acceleration in aggregate demand, the Fed persisted in calling it a transitory supply shock. All you needed to do is look at nominal GDP, and you saw there was the rise in inflation. It was due to excess demand, and the Fed just didn't stick to just simple economic fundamentals, and that was just clear in all the data. And so it was a major mistake. And the follow-up point from that is, and Peter addressed it when he said inflation's still 3%. We're still, the economy's still paying the costs of the Fed's earlier missteps in having big distortions to the housing market and other factors that are having a big impact, not just on a macro level, but as we discussed at our dinner last night, on a micro level by age cohorts.
Thank you. Let's go to Andy and then the gentleman over there, please.
Hello? Okay. So I'm Andy. So I just wanted to follow up on two of Peter's comments. First of all, Ed Nelson's amazing, and it has been really disappointing to me. I'm actually proud. One of my sole accomplishments at the Fed was to hire Ed Nelson into the Monetary Affairs Department. And the extent to which his work has not been gotten the attention that it deserves at the top. It's been really unfortunate. Okay, the other thing I want to say, which I think is relevant for Mickey and Mike, the Fed itself has been very eager to pat itself on the back for the great job they've done since 2022. They're kind of, oh yeah, well maybe we made some mistakes in 21, we're a little bit too slow, but since then, okay, and I want to push back on that. I think it's absolutely wrong, and we should understand as part of the conventional wisdom here what actually has happened. So first of all, the Fed's message is, oh, we got they call it immaculate disinflation. Okay, inflation comes down, we're basically back to target, and it was free. There were no costs to that. That's completely incorrect. So first of all, you look at the employment to population ratio, that peaked in 2023. It's come down by a percentage point since then. And it's not tariffs, it's nothing that this administration has done. Okay, that started in 23, and it's exactly what we'd expect from a monetary policy tightening. Okay, so there's a sacrifice ratio there. This wasn't free. And the unemployment rate's not a very good signal of this, because some of this is people coming in and out of the labor force. The other piece of it is inflation. And I think that the extent to which a lot of the improvement in inflation was because of goods, affecting by the reopening of supply chains and disruptions ending. Okay, core services, which Chair Powell emphasized would be the key indicator the Fed would look at in guiding their decisions. And he promised, we'll do whatever it takes. Okay, well, where is that now? Before COVID, they call it super core. Okay, so it's core service excluding energy and excluding residential housing, was around 2%. And in the latest data we have, which is a little bit noisy, but in the latest data we have, it's around 3.5 to 4. So the Fed didn't finish the job.
Andy, sorry, just looking at time. if we
Yeah,
could-
so I guess I'm hoping maybe Mike and Mickey in the revision of this or in the next paper you guys write, and hopefully you'll write a whole lot more, that this needs to be carefully considered, because that's meant that basically the next Fed chair is left with a very uncomfortable position, and that the previous Fed chair was supposed to have fixed things before he leaves office, and I'm afraid that's nowhere near.
Thank you. If you can just hand the microphone over.
Hi, Guy Hazelman. I think, Peter, what you were suggesting by targeting nominal GDP is you sort of take the micromanagement out of a $30 trillion complex global economy, which is what they've done. And when I think about what do you want from the Fed? You want them to be credible, effective, and accountable. And if I think about what we've talked about on this panel, and then I think about the first panel, a lot of overlap. The first panel, the whole thing I could think about was Lowenstein's book, America's Bank, the epic struggle to create it. Well, the epic struggle was about the fear of the Fed gaining too much power. And what they've done in recent decades is exactly that. The strategy drift Anne Marie was talking about. Treasury controls the weighted average maturities, but then they're in there buying. So they've done more and more and more strategy drift, especially since the GFC. And they're kind of weakening then the regional banks. So really what I'd like you to comment on is like, what is it going to take to the Fed to go back to its mandates, ignoring things they can't control, like the tariffs. They have a dual mandate, and it's strategy drift and more power now kind of within the Beltway. Maybe you could comment on that.
Okay, panelists, I'm going to give you very, very brief. If you have anything you want to comment on, that would be great.
There's no guarantee. I mean, the next Fed Reserve chair is going to set the tone, and maybe it will be somebody who has strong ideas. You can accomplish more by trying to do less, or maybe it will be someone with, who's incapable of doing that. I'm sort of bullish. I think things will work out because it seems to me there are big gains from doing the right thing. But that's a forecast.
Sorry, we do need to.
Yeah. Just a
Well
comment.
taken.
Just a comment on Andy. The general price level is more than 25% higher than it was before COVID. And if you think of the consequences of that for society, particularly lower income, people who rent, who haven't benefited from the appreciation in housing, who have to eat. It has, and for the Fed to say, you know, everything's just about right and we did a really good job, it just rings hollow for the key central bank in the world.
Okay, I'm afraid we're going to have to end there. I knew it was going to be lively. Please join me in thanking our panelists.
That was good.